Hi everyone, this is Trader Steve, and as this weekend marks 12 months of recording and posting up on my blog the performance achieved on my own trades and those that I tweet in real time to people I train and mentor, I thought it'd be useful to go through the performance, pick out one or two aspects, and also highlight one or two areas for possible improvement going forward. Now, what you see in front of you is my own spreadsheet that I've developed, tweaked, refined over several years. Even this week, I added a new metric to it, always adding to it. There are obviously several good spreadsheets or packages that you can download to do a similar review, if you like, of your own performance. But I think it's very important for anybody who's trading in the markets to record all their own trades, review performance, and then make any adjustments to your strategy or your parameters, etc., going forward based on that review. I think that's a very important aspect that a lot of inexperienced traders or traders who maybe trade part-time or may look upon it as a bit of fun. Trading is a serious business. You've got your own capital, your own money at risk, and therefore you should take it seriously, treat it as a business, and record your performance, and always look for ways to improve it. That's something I've always done, and that's something I always advise people to do, because going through performance statistics like this, it can highlight possible errors in your own strategy. It can highlight errors in execution. It can highlight errors in aspects such as trading positions too large relative to your equity, opening too many positions too quickly, not opening enough positions quickly enough, all these sort of aspects, not updating trailing stops on existing positions, all these sort of aspects can be highlighted by recording and reviewing your performance. One thing I also advise people is to actually take screenshots of charts when they open and when they close the positions, and also have a pictorial record of each individual trade, and if necessary annotate some notes on those charts, so you've got a visual reference as well as to why you took certain trades, and why you closed certain trades. So anyway, that's the basic rationale, if you like, as to why I believe every trader should track performance in this manner. Just a couple of basic rules, if you like, regarding my performance. I live and trade in the UK, and I use a spread betting or a CFD strategy, which are both leveraged products, but they do track the underlying stock share price pretty closely. I risk 2% of my capital per trade on a fixed fractional basis, and for the purposes of recording the performance on the blog, I've used a starting capital of £20,000 back in July last year. So when I started recording these trades, the initial position size was £400 risk per trade, i.e. 2% of £20,000. And as you can see here, this is basically the summary of all the number crunching done on the other sheets, which I'll go through shortly. And you can see that if I highlight here, there's been just over 160 trades in the year. That may sound quite a lot in actual terms, I've been actually very lightly invested pretty much for most of the year. I do have position limits which I do not exceed, but I don't think I've reached those position limits once in the course of the 12 months. So I've actually been underinvested based on my basic rules pretty much all the way through the year. You can also see that the number of losing trades slightly outweighs the number of winning trades. Historically, I've always got or achieved about a 50% win rate. With the basic conditions in the markets over the last 6 weeks, the actual performance over this 12-month period has fallen from slightly above 50% to down to 47%. It fluctuates from time to time depending on the market conditions, whether the markets are trending or not. Obviously, in the last few weeks, we've had a significant increase in volatility, and the markets have sort of been whipsawing around, possibly showing a change in direction, and that has contributed to the drop off in the win ratio over the last 5 or 6 weeks. You can see pleasingly that obviously we've created a net profit over the year, despite losing more trades than we've actually won. And in terms of R, how much I risk on each trade, I've actually made almost 66 R over the course of the 12 months. And just below that, you can see the percentage return over the course of the year, 156%, which sounds great, but as with all traders, I suppose, I'm always looking for ways to improve my performance. Certainly, being underinvested throughout the year is one aspect that I'm looking to address in the next 12 months, and obviously, providing all the other performance metrics stay the same or very similar, then the return will increase. The profit factor, which I show here, basically states that my average profit is just over 3 times larger than my average loss, which is good. That's been, again, pretty constant over the course of the last 12 months. And as I say, the only fluctuations really in the performance over the last 12 months have been based on the win ratio, and that is determined, if you like, by the prevailing market conditions. If I go on to this tab, I've got here all my individual trades listed, and they've been resourced in the dates they were closed. And as you can see here, there's 5 positions here that are still open as of close of business yesterday. And this is where all the number crunching is done. And as you can see here, this is the key one for me. Risk reward ratio on closed trades, and as you can see here, the figures in red show the losses, the figures in black show the profits, and what you should see is lots of small values in red denoting small losses, contrared by the occasional small figure in black showing a small profit, and then the occasional large figure such as here. Whereas on this particular trade, which was the US stock super value, when I closed that trade out, which was open for just about 3 months, I achieved a near 9R profit on that one trade. And as you can see at the moment, the trades I've got open are all in profit. Cumulatively, that's another 7R in profit as things stand last night. As you can see, I've tracked the open and cash balances going forward, which obviously started at £20,000 and rolled forward, and on a pure cash basis, that's up to £45,000. It's about 125% return on the year, including the open profits. That's now up to 51,000, which is where I get the 156% result for the year to date. So that's where all the number crunching's done. From all this, I can produce a trade analysis, and those of you who have purchased my ebook will know that in there I talk about probably 80% of the trades over a course of a trading sample will cancel each other out, small losses, small profits, and it's the remaining 20% that produce the overall profitability of the system. And this is sort of borne out here by the distribution of the trades over the course of the last 12 months. The bulk of them here, sort of around the break even, small losses, small profits. I had 2 trades in the year where they gapped down against me, and I ended up with losses greater than 1R. And then going the other way, there's a few trades that were in excess of 4R. As I say, the biggest one in the year was 8.8R. This tab here shows the equity curve that's been achieved. I've posted this chart up several times on the blog throughout the course of the 12 months. And as you can see, it sort of goes up in a bit of a staircase fashion. And again, that bears out a typical trend following performance, if you like. Small losses contra by small profits, or the occasional break-even trade, and the big jumps in the equity are achieved when profitable trends that may have been running for a while finally close out and cause a jump in equity. And you can see there's basically 3 large increases during the year. So that's borne out by the weekly figures that I keep track of here. You can see here in September there was 3 weeks in a row where equity went up 15%, 14%, 10%, which caused this large increase here. A further 15, 16% increase in early January, which was up here, and then going further down, there was a 17% increase at the beginning of June, and that's basically where the markets topped out in late May, which meant that a lot of long positions were closed. Some had only been open for a short period of time, but 1 or 2, maybe a couple more, had decent profits on them, and that caused that big jump there. And that's typically how a trend following system works. You'll get periods where performance is not really going anywhere. As you can see, there's plenty of weeks here where there's very, in some weeks there's no movement in equity, no positions closed, a couple of small losses, then you've got 1 or 2 big, 1 or 2 profits going the other way, and then every so often you get the big jump in the equity. This tab here sort of basically replicates the actual performance achieved, which shows me the expectancy per trade, 0.33R, and although it doesn't quite match exactly, this is again, it's just used as a guide, based on the average number of trades I open a month, and on the spreadsheet I do keep a track of the average holding period for each position. Obviously, trades that do not work, I tend to close very quickly, 1 or 2 days, and it's the profitable trades that are kept open. But in the overall scheme of things, it roughly works out over the course of the year. I was opening 13 trades a month, slightly less than that, as this is showing a projected annualised return of 165, and my actual return was 156. Possible ways I can improve performance going forward. You can see, just going back to the trade log briefly, a lot of these losses are very small, less than 1R. That's one of the trades there which gapped down on me and ended up with a loss bigger than 1R. So there was 2 in the year, both about 1.6R. But you can see a lot of these losses, 0.09, 0.36, 0.2, 0.21, they're a lot less than 1R. And that's because I'm very conservative in where I place my initial stop, based on volatility. it is quite possible that I could move that initial stop closer. That would mean that my losses would increase. Instead of getting a loss of, say, 0.2R on a trade, I could quite easily get a loss of 0.4R. But by the same token, if that trade went in my favour, instead of getting a 2R profit on that trade, I could end up with a 4R profit on that trade. And just for example's sake, if I halved my initial stop distance, which I say is pretty conservatively based on volatility, if I just tweak this spreadsheet, just double both these parameters, you can see how the expectancy per trade has increased, obviously up to 0.65R, and that jumps the annualised return from 160% roughly to 550%. Now, whether you want to do that while you're still risking 2% per trade is again a discretionary decision that each trader would have to take. Obviously, the closer that you place your initial stop, you're potentially bringing into play a much bigger loss should a stop gap through your stop level. What could end up as a 1.6R loss, like I mentioned, I had 2 of those in the year. They would end up as being 3.2R losses. Risking 2% per trade, that basically would mean a 6.5% loss of equity on that one trade. Now, would I be willing to risk that? Not sure. As I say, everybody has their own ideas of what is aggressive, what is conservative, etc. You need to factor all these things into your overall risk management model, if you like, and that's something I'm going to be looking at and possibly tweaking over the next 12 months with a view to trying and increasing performance, along with increasing the number of trades I put on per year. As I say, any losing trades are cut very quickly, sometimes even on the same day that I open them, and it's the winning trades, the profitable trades that are left to run. You come back to the old maxim of cutting your losses short and letting your winning trades run. Again, just using this as a base example, I could tweak the parameters so that my initial stop is closer. If I doubled the number of trades I put on a month, then you can see the change in the projected annualised return. Even if I reduce the risk percentage back down to 1%, and so I could reduce the size of my initial, or move closer rather, my initial stop, potentially increasing the reward to risk ratio on the trade by half, and I could also reduce the risk per trade by half, and I would still achieve the same projected annualised return. So these are things that, as I say, each individual trader has to look at, has to weigh up. If you want to try and obtain the rewards, then you have to accept the risk. As I say, everybody has their own ideas on what is aggressive, what is conservative, etc. But hopefully, this has given you sort of an idea of how to review your trades, how you should record them. Certainly, I would strongly recommend that for anybody who trades in the markets. Use a spreadsheet like this, or obviously, as I say, there are several you can look at and purchase off the internet. Make a plan, execute that plan, control your risk, and hopefully you can achieve decent results like I've shown here and on the blog over the last 12 months. Thanks for listening.